We might finish it today. I hope we do. Raise your hand if you hope we finish it today. I know I do. Okay, yeah, so that's it. All right, let me go ahead and pull up. What a mess. No, okay. So let's go to, so this is, so we did the straight line method. And the straight line method is probably the most intuitive. If you didn't know, if no one told you anything about depreciation, that's probably, one that you would come up with. Units of production is the second one here. And this is, it's similar in that it's based on the life of something, but the life isn't in years. For some things, like for instance, this is a truck. And the useful life is in miles. And the idea being that you may not use the truck the same every year. For instance, if the truck is a snow plow, some years, like this year, we get clobbered. Some years you hardly get any. So the something like a snow plow, to depreciate it in years where you might use it hardly any in some years and a lot in others, doesn't really make as much sense. And only that, if you have a snow plow, you're probably going to bill people a lot more. You're going to make a lot more money when it snows a lot. And you should match up the expense of the truck with that increase in billing. Whereas years that aren't so good, you don't bill very much. The truck probably doesn't take very much wear and tear. So the units of production is another method that is somewhat intuitive in that it's for things that aren't used the same every year. Okay. Whoa. We have let's all together make a correction here. You'll notice that we have two 2021s. Now, one thing we don't do is repeat years. So let's change this to 2023. So make sure you change that. That was an error. Oops. Look at it. I made an error writing error. Okay. Yeah, so that's an error. Make sure you change that to 2023. Did I do that on all these? I probably did. Yep. Oh boy. Well, these are all right. I don't know. Okay. Well, we have a couple of corrections to make. I apologize for that. All right. So let's get back to the problem here. Okay, so we purchased a truck for $32,000. This is the same as the first one, except we're going to do a little bit different. Now, it starts out exactly the same. What I mean by that is that we take our cost. I gotta move this thing. I'm gonna use my calculator anyway, so the calculator, put the doggy calculator cam back on. Okay, so the cost is $32,000. And we have the residual amount is residual value. Oops. Come on. Is 8,000. So it's going to go down from 32 down to 8,000. I am not paying attention today. And this will give us our depreciable amount. right, so up until this point, it's exactly like the other one. It's exactly like the straight line method. Now here's the thing. The $24,000, we're not going to divide it by the years. I don't think I put the years on that one. But what we're going to do is use the miles. So we want to figure out what the depreciation expense is per mile. And then we can multiply it by however many miles they use in a year. So we're going to figure out what the depreciation expense is per mile, not per year. Okay. So its useful life is 100,000 miles. So what would the depreciation expense be per mile? I mean, you figure that out, either blurt it out or put it in chat. So how much are we going to depreciate per mile? Oh, come on. Somebody knows this. How much are we going to depreciate per mile?
Is it 0.24?
It is. Yep. Yeah, so it's going to last, its life is 100,000 miles. So we're going to divide this by. So this will be the depreciation per mile. Okay, so this is what we're actually going to, let's make it a different color. I want blue. So every mile we're going to depreciate 24 cents. By the way, this is what they do for taxes. For taxes, it's there's a couple ways. You can do it another way too, but most people do it this way. They give you a certain amount you can depreciate. So what we're going to do for each one of these up here then is say, okay, well, if this is 10,000 miles, we're going to multiply this by that. And that's how much it will be depreciation. Oh, wait, I can do that with my head. Wait, okay, let's see. So it's 10,000. $2,400. So this will be the depreciation expense in the first year. Go to the next year, same thing, times 0.24. $13,200. Okay, so these will be the oops, these will be the depreciation expense every year. Will be, well, not every year, so each year I should say. But 2,400 in the first year, 13,200 in the second year, 84 in the third, and you'll notice that at that point we've reached 100,000 miles. I think, yeah. All right, so journal entry be the same as you did before. 2,400. And this will be 13,200. Yeah, so these, so again, these are those amounts, by the way. And the life in years doesn't really matter too much because that's not how you're, you know, this truck may last for 3 years, it may last for 10 years. It just depends on how much you use it. So we're actually just looking at the what they call production. It could be in miles, it could be in units, it could be in hours, it could be in all kinds of things. Okay. So these will all be the depreciation expenses. Okay, coming down here, I'm going to put the expenses in because these are all different. 2,400, 13,200, and what was it, 84? 8,400. Wait a second, maybe I can't do that. Let me see what I did up here. Okay, I'll make them a different color. All right. Okay, so the assets. So this was what, a truck? You could put equipment. Equipment's fine too. So truck or equipment. Either one's fine. All right, what do we pay? 32,000. Okay, depreciation first year is the same as the expense. We've only had it for 1 year. And the book value would be 32,000 minus that. So let's make that, what do we make that? Purple. see that? Yeah, I can see that. Oh, I don't know. Okay, so I don't like that. Let's just use a color. Oops. All right, so 32,000 minus 2,400 equals a number. You guys probably already knew that. 32,000 minus 2,400, 29,600. Next year, same thing. $32,000. Oops. Now the accumulated depreciation for this year will be both years together. So this plus that. So 2,400 plus 13,200, 15,600. So 32,000 minus 15,600 equals what's going on here? How weird. All right, fine. I won't be able to be fancy. 16,400. Oh, it is letting me do it now. Okay. All right. And in year 3, same 32,400. Okay, it's going to be all 3 of those together. And you can just take the 15,600 plus the 84. That's probably an easier way to do it. But the idea is that all the depreciation expense together. Come on. Oh. Well, that sure looks confusing. All right, so 15,600 plus 8,400. And that 24,000 should look familiar. That is the depreciable amount. And the book value. Marky has an error in here. Okay. The book value is 8,000. And again, that is this. So this is the depreciable amount. And this is the residual value. So at the end, it's going to be depreciated down by 24,000, and it'll be down to the residual value, to the 8,000. Ah, what happened? Not sure what's going on there, but any question on that thing? And again, this one's it's a little bit different in that it's actually using it, what they call the production. How many miles are we running on this thing? The reason being is that we don't use it the same every year. If you use it the same every year, if you're going 30,000 miles every year or around that, you just use it. Using a straight line is fine. But if you don't use it the same every year, then units of production is a better method. Okay. Now, by the way, this is an error also, so to correct this. That should be 2023. Okay, so this is a machine. Yes. And this machine has a life of 50,000 hours. So these, instead of miles, we're going to use hours. Okay, those aren't together. Okay. Starts out exactly the same. Oh, weird. I don't know what I did there. I switched to New Times Roman. Oops. Yes, I think. Yes. Oops. Yeah, so this is a depreciable amount. And this green list? I can't remember. Anyway, and so now we're going to depreciate it again, not based on miles, but we're going to use this machine for hours. So divided by so 1.6 or anyway, $1.60, same thing, exactly the same. So this will be the depreciation per hour. But 1.6 is fine. The zero doesn't do anything. Okay, so we're going to multiply this. And actually, 1.6. 1.6. Is that 32,000? So 20,000. 32,000. Oh. Okay, and again, you can see that we use it for different amounts every year. So because we use it for different amounts every year, it makes sense to use this method because the straight line method, it's the same every year. And if you think about it, they dropped down to 12,000 hours in 2022. If you think about it, that's probably because they made less items, they probably sold less, and the depreciation should be less. They've used the machine less. So, okay. Journal entries, same as we always do, depreciation expense. And again, those are just the same as up there. Again, those, you know, the depreciation must be, those are the same every year, same thing. Okay, so this asset was a machine, could also be called equipment. $20,000. And that's gonna be the same every year. Oh, I should put the depreciation expenses in first. 32,000. $19,200. And 28,000. Well, I only asked for the first 2 years, but I'll put in the third year too. It's like one more year. Okay, so all right, let's see, let's make those. I mean, use green last time. Yeah, I'll make it green. Okay. All right. So accumulated depreciation will be the same in the first year as the depreciation expense. All right, 120,000 minus 32,000, 88,000. Okay, the next year. Now, again, all the depreciation to date. Insert. So 32,000 plus 19,200. 51,200. And that will equal some number. 68,800. It only asks for 2 years, but I'm gonna go ahead and do. I'm gonna do all of them. It's only one more year. Gonna round it out. Oops. And 51,200 plus 28,800 equals 80,000, which is what we would expect. Any questions on that thing? Okay, the last thing we're going to cover, probably the kookiest thing in the entire course. It's a double declining balance method. It's not intuitive. You know, people ask, well, why do we do this? You know, why do we do it this way? We decline the balance. It's actually playing with numbers. I know that's not a very good explanation, but that's what it is. And the idea is that an asset is more useful in the early years and less useful as things go on. It's similar to a car. If you buy a car, it depreciates the most in the first year. You know, when you drive it off the car lot, it goes from being a new car to a used car. That first year, you take a bigger hit than the rest of the year. The difference between a new car and a car that's 20 years old can be significant. It's no longer a new car. As time goes on, that's less and less. Now, what's the difference in the value between a car that's 10 years old and a car that's 11 years old? Probably not a lot. You know, if they're in the same condition and all that kind of stuff, it probably doesn't, you know, it's probably not a big difference. So the big differences in the usefulness happen early on. And that's kind of an economic thing, but it's also, you know, if you're matching up expenses, that it doesn't go by not necessarily. I know we're talking about the market value for a car, but the market values is not really what we're talking about. We're talking about the usefulness. So usually things are more useful in the periods, which is similar to those economic things that come. A newer car, you know, it has less everything works on it, it's less maintenance, it's got a warranty and all that kind of stuff. So it's more useful than a car that's say 10 or 11 years old. And this method mimics that. It's a very quirky method. It's not intuitive at all because it's basically playing with numbers to make the first years have more depreciation than the later years, because an asset is more useful in the first few years than it is in the later years. So, you know, this method, if it's very confusing and it doesn't make intuitive sense, you got to realize that it's playing with numbers to have more depreciation early on and less later on. And it's a can of worms. Now, you may say, well, does anyone use this? Yeah, they do. And the tax tables are all based on this. So when you do your taxes, for any company or business, whatever, or even personal, if you own a building, something like that, this is what the tax tables are based on, the double declining balance method. So while it's not intuitive, quirky, it's actually used quite a bit. Okay, so let's go to it. You got it? Okay. All right, double declining balance method. This method is different than the other ones, and it starts out with the total cost first. You do not take out the residual value. Times one divided by 5 years. In this case, the number of years is going to be so this. Let me see. Try to see here. Times 2. Equals the depreciation expense for the first year. 32,000. Oops. Let's get the calculator cam on. 32,000 times 1 divided by 5. You also say divide by 5. So 6,400 times 2 equals 12,800. Okay, so this will be the depreciation expense for 2020. That's not so bad. Okay, now for the second tricky part. We have to decline the balance by the depreciation expense for that year. Oops, oops. Try that again. Okay, so I'm going to make that So double, there's a double, and here's a declining. So we go to the next year, and we do the same thing, but we're going to take 32,000 minus the 12,800. $19,200. And we're going to do the rest of this the same. So 19,200 times 1 divided by 5 minus 2, or you need 9,200 times 1 is just 19. So you can just divide this by 5 if you want. And times 2. Decline the balance. And by the way, if you're this total cost or that you start with, this is actually the book balance. I should say book value. And at the beginning, it's going to be the 32,000, but I start with the total cost. You don't take out the residual. Okay, so 1,520. Okay, we have to stop right here. There is a problem. The problem's with that number. What is the problem with this number? This is the book value. What's the problem with it? What's the problem with having a book value of 6,912?
It's less than the amount you would be losing.
Yeah. The residual value is 8,000. We can't go below 8,000.
Okay.
So we cannot depreciate this amount for 2023. Too much. Oh wait, what would I do there? So we can't, that line is not very,
You probably hit the undo button.
yeah, I don't know, but the cross outline, you can hardly see it.
Oh, okay.
You can make it, you know, no,
There we go.
there's a cross outline there.
Okay, I see it there.
Yeah, so we can't depreciate 4,608. It's too much. So the question becomes, well, how much can we depreciate in year 2023? You know, we can't depreciate 4,608 because it's too much. It goes below our book value. So the question is, how much can we depreciate? I'll give you a hint. This is our book value after year 2. After year 2, our book value is 11,520. So how much can we depreciate in year 3, 2023? This is too much. Anyone?
Would it be like 3,520?
Exactly right. So okay, so what we have to rely on then is go to the book value of the previous year. Minus the residual amount. It does not spell like that. Of 8,000. If I don't put this underneath here, it'll be better. No, I apologize, guys. Okay, minus the residual. Who's there in accounting today? Mr. Taylor has no idea how to work a computer.
What do you
All right, so
want to do something?
this will be the depreciation expense. In 2022. So 3,000. So 3,520. So we can't use this as too much. So most we can use is 3,520. So this is that. I wish I had more colors to use here. That's kind of crazy. They make these so dark. You highlight them and you can't see anything. I guess they make it gray, but gray doesn't really, gray doesn't exactly pop. You know what I mean? So if you go below the, so this is below the, so below the residual value, so you can't use that. So, this lesser amount you can use because this will get us down to the 8,000. Okay, again, kooky method. So these are the depreciation expenses. 12,800, 7,680, and this is 3,520. So this is going to be completely depreciated in 3 years. Now, notice it's a 5-year life, but it'll be completely depreciated in 3 years. And it does do what we want it to do. It depreciates more stuff early on. All right, well, let's fill this in here. So first year depreciation expense of 12,800. Okay, so that's just those up there. So let's see. All right, so coming down here, I'm gonna put the depreciation expenses in here, the wacky one, so 12,800. 7,680. The last one was 3,520. Okay, so this asset, what was this? Truck. You say truck or equipment, either one. Okay, so truck was 32,000. The depreciation first year will be the same as that, is 12,800. Oops. And this actually, we actually already did this. The book value is 19,200. Yeah, once you get it done, I mean, once you do this, like this is not too bad. The depreciation will be, let's do together. Plus 20,480. And this should not be just the same as that 1120 we had. Let's check this to make sure. 520. All right. Insert shapes. For 1,000, which is what we expect. Now, this will, you won't have any more depreciation expense, but you're still gonna have this on the books for 5 years. Oops. Okay, so that's the kooky double decline balance method. It's not intuitive. So probably some accounting student that was bored in class came up with it. In class, bored silly and came up with this method. But it does do what we want it to do, though. It expenses more early and less later on. Doing a little bit of quirk here that, you know, zero depreciation expense for the last couple of years. But it's a very strange method. Yeah, the weird method of it is you start with the entire amount. Too many colors here. So you do not subtract out the residual value. You start with the total book value, with the total cost. First year will be the total cost. And you start out with the book value, which is the total cost. And then you just keep going down, and the book value keeps declining. Can't go below the residual value. So then you end up with this kind of strange thing down here. Questions? Okay, that's probably enough of that. We'll hold off. We'll do this page 6 later. Question? Yeah. Again, it's kooky, but it actually does what we want it to do. Yeah, you know, it depreciates more early on. And yeah, it's yeah, it's kind of kooky. And by the way, if you, I think I told you that this is what the taxes are based on. Now, for taxes, you really like this. For taxes is different than other accounting. In taxes, you really like expenses. Expenses are great. Losses are great. I bought a 3 flat in Chicago years ago. And I remember the first year I lost $11,000. Yes. Like $4,000 in cash. So anyway, but this depreciating a lot early on is very good for taxes, you know, because you get to write it off. And by the way, one more thing about depreciation, you know, and let me jump back into it and kind of show you why this is so. You'll notice this journal entry for depreciation. Did you actually write a check for $12,800?
No.
No. These are what they call paper losses. So here's the great thing for taxes. You know, you can write off $12,800. You didn't, you know, write a check for that. It's not cash going. So that's the beauty of this for taxes, is that, you know, and why getting more early on is good. You'd rather have your money today rather than, you know, 2 years, 3 years, 4 years from now, whatever. So these are what they call paper losses. And for taxes, those are good because you can write them off, but you don't write a check for them. So it's basically money coming back to you. So you hear about paper losses that they really didn't pay any cash. Depreciation is one of them. So there is no cash here. And you get to write it off. So having this method for taxes, well, it's a pain in the butt. It is good because it okay. Any questions there? Like I told you, the $11,000 loss, I had 500 or something like that. Anyway, it was all paper. I didn't write a check for $11,000. Okay. Any questions?